As we wrap up the earnings season, it's time to reflect on our featured stories and guests. Our discussions spanned across various sectors, including technology, retail, entertainment, and more. These discussions offer an exclusive glimpse into what lies ahead in the market. Take a listen.
Here's where we're at. When we saw real hyperinflation last year, we took aggressive action, as most food companies did, to protect our margins. We have not had passed on a price increase to our customers since about July of last year. So our team's done a nice job of holding that. We're going to be lapping all of those prices. We want to meet consumers where they are in the back half. And we believe we're in a good position as we lap all of the prices, try to hold it steady, deliver value to our consumers in the back half, and see volume recover as we do things like family packs that provide more value to consumers, and use our productivity initiatives to hold pricings where they are. So it's certainly coming out of a spot. Our consumers are certainly feeling the punch, but we believe we're focused on that. We're focused on delivering that value to our customers, ultimately to our consumers, and expect to see that volume recover as our price impact inflation to the customer really goes to back down to normal levels.
Andy, it's Brian here. Always great to get some time with you. I'm going to refrain from asking you if you've seen a pickup in your convenience store business with all these big lottery jackpots, but I will ask you this. Have you seen any impact to the convenience store business lately as gas prices have been back on the rise this summer?
You know, it's a summer season, so we do see traffic more recently, with the rise of fuel, that sometimes has an impact on our consumers' behavior. And a lot of times it increased the frequency to the store because they're not filling up the tank every single time. What we're seeing right now is a slight increase of traffic. We're about flat year on year. That was slightly down in Q2. We expect it to continue to rise, and we're well positioned for that business. Brian, as you know, we have a terrific C-store business. Scott and the team do a great job. We have availability that's about 20 to 25 points greater than our next closest competitor. We're bringing them innovation. So I feel like we're in a good spot for convenience, but certainly we watch those fuel prices very, very tightly.
Something that we've been keeping a close eye on within the consumer price index readings that we get monthly is this food at home figure. And that increased by about 0.3% over the month here. And the reason that we're keeping an eye on that is because that directly correlates as well to your business. If people are going through one less aisle and saying to themselves, you know what, I need to cut back on that particular part of my grocery experience. How do you make sure that you're retaining that customer? And is there any pickup in those grocery aisles among some of the newer products that you've introduced into the stores?
Yeah, a couple of questions there. The first is we partner with our customers to really throughout the store. We have many points of interruption throughout the store. It's not just the aisle. You are right about the number of units in the basket to offset the price, but we're in a very accessible snack. And as I said before, we try to give our customers the right value. We feel like we're set it back to school. We sharpen value where we think we can. We launch value family packs, which are doing very well, which allow consumers to really participate in larger sizes, but a better value. So we do all of that and partner with our customers in a very good way to be able to take advantage of that. Related to our new items, they are really doing well. And that's one of the reasons why protecting our margins, but doing it not just through price, but through productivity, which our team's been able to do, is really important. It allows us to bring what consumers want. Our new Casbars offering is really off to a terrific start. It's a reimagined baked goods in a bar form that expands the consideration set into the $65 billion snacking universe for all of our consumers, and gives them really the quality of baked goods they expect for Hostess, but the indulgence of a bar and layers that they want. So these things like family packs and old-fashioned donuts and our zero sugar Bortman cookies are all ideas that we're able to bring to consumers because of our productivity initiatives. And that's what consumers are looking for in indulgent snacks.
Andy, earlier on today, I caught up with Campbell Soup CEO Mark Klaus, and I see a lot of similarities between how he leads, how you have led. I see similarities in the businesses. You have both led turnarounds of these storied brands. He just made a big acquisition. I mean, do you think there's a deal to be had out there over the next few months as we might start to see a pickup in consumer packaged food? Is there a new category you want to get in? In Mark's case, he's expanding into higher priced pasta sauce.
Yeah. Mark's a terrific leader. I've known him for over 25 years, despite being a West Point guy and I'm an Annapolis guy. He's a terrific leader, so I'm not surprised his success. He's leading Campbell's too. But very similarly, we look at the M&A landscape, and our frame of reference is around snacking and indulgent snacking. And we have built over the last several years capabilities, whether it's consumer insights, marketing and innovation, our supply chain, to be able to take advantage of this growing $65 billion landscape. And we see that M&A and some of these businesses that are maturing are at the right spot that may have been interrupted by COVID, really moving into that space in a really nice way. So it's always part of our calculus. Our number one place for capital is our core business, and number two is M&A. And our team's doing a really nice job of doing that. We're coming out of building out our Arkadelphia bakery, which expands capacity we need. And our next priority is M&A. We think we're in a really good job for that. And if not, our organic growth and our long-term algorithm will create great shareholder value.
Well, the Traeger Grill's CEO once told us that Americans love grilling. And Andy, you've made a good case for Americans loving snacks today. Hostess Brand CEO Andy Callahan and Yahoo Finance's executive editor Brian Sozzi. Thanks so much for the time. Also, as we've been talking about, earnings from Lowe's this morning coming in a little more optimistic than its competitor Home Depot's results last week. Lowe's comparable sales down a little less than expected at 1.6%. Meanwhile, Home Depot's were down 2%. So what do these results really say about the housing market? Joining us now, we've got Cole Smead, Smead Capital Management CEO. Cole, great to have you here with us this morning. So perhaps we could start off with that question. What does this say about the broader housing market, given that you've got two of the larger DIY plus some of those larger business-to-business contracts and purchasers that take place for both of these companies?
Yeah, so we've owned Home Depot for years. We think housing has been probably the most misunderstood part of the economy looking back over the last 10 years. No one thought we'd be where we're at on housing, where tight supply, even though affordability is terrible right now relative to the last decade, is causing housing to be strong. I think what Home Depot and Lowe's have had to deal with is, as interest rates have increased, it just marginally caused people to look less to a home equity line to revamp their home and do things of that nature. That's a bigger component of their life versus just housing supply itself is really more to do with the home builders. So I do think the one tailwind that Lowe's and Home Depot have and will continue to have for many years to come is we've busted one of the great myths of all time, which was that millennials were never going to buy houses. And now that they own them, that's such a huge customer base to those retailers. And those DIY companies like Home Depot and Lowe's, I think, have really good secular trends in their favor.
At the same time, housing is getting less affordable, right? In part because of what's going on with interest rates. In part, we're just not seeing much movement within the existing home sales market because people don't want to sell to pay those rates. So are we going to have a period of more stagnation that's going to continue?
Well, to your point on supply, it's such a healthy environment. In other words, why are high rates not, causing housing to fall apart? Because there's no available homes for purchase. What are some other myths that were out there on housing? Baby boomers were going to move out of their houses and go into assisted living earlier on. That never happened. COVID proved that won't happen. They'll live in their houses till they're 90, which would be a shock to what people thought 10 years ago. So I think there's other trends that are going on in housing that are really causing that tightness. But again, unless you have the higher income from a new job or you're getting paid better to move to a new area, you aren't going to leave your 3% mortgage, 4% mortgage, et cetera. It's only based on income will someone do a move up trade or just a pure need and they have the equity to do it. That's a very healthy housing market. Go back to 2007. You'll find we had the largest supply of homes available for sale that we've ever had. Which housing market would you want to be in? The one that's going to be a nightmare for years, or tight supply that looks like it's going to be a bull market for quite a long time? By the way, housing's the only good game in real estate, just so we're all on the same page. It's the only game in town doing well.
And so with what you're seeing in housing at this point in time, and I'll give you some anecdotal evidence. I went back home to Pennsylvania, at least where I grew up, and There's an entirely new kind of just residential community being built up where there used to be cornfields. And we're seeing that in several states. This is just kind of one example. And I have no doubt in Arizona, perhaps not cornfields being transitioned, but some other area where it was wide, vast, open, where new developments are popping up. And it seems like much of that could be driven by a few things in each of those markets. And all of this to say, are you seeing more perhaps new first-time home buyers saying, you know what, we'll just try and get a new home versus purchasing an existing home and then doing a bunch of the DIY renovations? What does that tell us about the housing market?
Well, there are no homes for sale. So it has to come from new supply ultimately, because someone's got to move to that new supply to make, the existing homes, up for sale. So I think, again, new supply will tell us what's going to happen in housing. Whether you're Home Depot or Lowe's, or whether you're Lennar and D.R. Horton. To your point, a large project out in the cornfield, to quote the Monty Python, "'tis merely a flesh wound." It's not changing supply at all. Here we are in Arizona, water's a big deal. So you go look at municipalities like Maricopa, Arizona, Casa Grande, Arizona, you'll find that cities like that have water, they're growing rapidly. They're some of the fastest growing cities in America. If you go to other municipalities where you don't have water, you're not going to grow as much. So I think there are some, constraints in each market. Some markets, it's just available land. How costly is that land? In other places like the West, it will come down to water. But don't forget, when you turn corn farmland into housing, you actually use less water. It's one of the things I always tell people here. If we turn fields into houses, we got a lot more water here in Arizona.
When you're looking across the real estate industry and just trying to decide where to invest, as you mentioned, other parts are not doing so great, but there are parts like data centers, like warehouses, et cetera, that are doing a bit better. I mean, forget about office for a minute. Are there other areas of real estate that are interesting to you guys?
So if you look at the cap rates across the real estate space, it's gone from as good as it got at low rates to the largest rise in cap rates you'll ever see probably in your lifetime. So for example, use industrial. Industrial is trading at 4% cap rates. You're not going to find industrial trading at those cap rates. You're going to find them waking up somewhere closer to 5 or 6%. That's just tectonically different, because then someone going to develop new industrial has got to pay a premium to that because there's risk for the bank to have them build it. So I think that's really the trend you're seeing. Multifamily, I think if you go look at Howard Hughes Corp, they're trying to build apartments. They said, I think it was last quarter, they went to 49 banks looking for loans on a multifamily project. They couldn't get lending. That is very common. Banks are shutting lending down, or if they are going to provide lending, you're going to pay 10, 14, 16% construction loans. So I think that helps existing assets out there, but at the same time, it doesn't help the price of those assets. There's going to be less supply in a lot of real estate arenas, but I mean, we got to swallow kind of a pig through a python here. Commercial real estate's worth a lot less. We don't really know how bad it is. We don't really know what the reset price is. We're probably going to peak over 10% cap rates in commercial office. And then the question is, what's the good properties and what's the bad properties? I was just in Seattle 2 weeks ago. Downtown Seattle's a ghost town relative to when I grew up in that town. That's very common in West Coast cities. It's very common in parts of the East Coast as well. So we have got to get through those problems. And I also think that will spill over into the banking space as we look forward 5 years. Not all banks will be affected by that, but it just goes to show you that we have real problems based on the price of money changing. And obviously that's what the Fed's doing on the short end of the curve.
All right, next time you're in Seattle, I need you to pick up some fish seasoning for me because I've been asking everybody that goes out to
I'll be there next week.
Yeah? Done deal. All right, I'll write it down. Just while we're on the topic, though, of housing, Cole, just to bring it to some of the current events that have taken place, too, and I think about the hurricanes here, about all of these different kind of severe storm systems that people who are purchasing a home are thinking about even more so. Is that likely to move the needle on where people are even willing to either move and start new financing on a home project, or just move the needle at all in terms of where people are deciding to take up residence?
I think the affordability land is bigger than the weather. I mean, for example, Florida has had cheap land historically. If you look back 20 years, you always paid nightmare hurricane insurance down there. It's a very expensive thing to do. And so I don't think the weather side's a very big deal. Can you get cheap land? Back to supply. That's the supply question. If you can get cheap land, you're going to find supply grow in the region. That's why you're seeing building continue to grow in the South. That's why you're seeing, building continue to grow in the Southwest, in parts of the Midwest, but you're not seeing as much on the West Coast. You're not going to see as much in the Mid-Atlantic or the Northeast. So I think we're definitely seeing a trend of people moving. And I also think the other thing you can add into that is the work from home. It's not going to be as bad as it was in the pandemic, but we're definitely not going back to 2019 work standards. I think mothers with children that work, they're the dominant force in that conversation, and they're going to dictate to America how they're going to work and when they're going to work. And I think that's really changing housing, in my opinion.
Shares of NVIDIA are on the up after smashing estimates in yesterday's stellar earnings report. They're up about 6.5%. The chipmaker flexing booming demand from AI intelligence computing. Its data center business was the star of the show. It rose 141% from the previous quarter. The stock's stellar run was enough to convert some skeptics. Morningstar, the last remaining firm with the equivalent of a sell rating, finally upgraded NVIDIA to fair value. Stifel analyst Ruben Roy also upgraded NVIDIA to buy from hold after yesterday's report, and he is joining us now. Ruben, I know that you are getting more optimistic or more positive on NVIDIA here, but I want to start kind of from the other side of the equation. NVIDIA seems to be killing it from every potential angle. What could go wrong here? Was there anything in the report that gives you pause at all?
It's a great question, and thanks for having me, Julie. It's one of the things where the guidance and the outlooks have been increasingly strong, and we thought, gosh, when we had the earnings report in May and the July quarter guide of $11 billion, it's probably not going to get much better than that. And there were three areas that we were thinking about. Supply, right? There's supply constraints throughout the semiconductor channel, and we thought potentially there'd be some supply impact near term. China, expanded restrictions on technology sales into China. And then the third was just kind of after a massive CapEx investment cycle, there typically are periods of digestion. So you think about those three things. Well, guess what? NVIDIA talked about all three and essentially took away all of our concerns on the conference call last night. So starting with supply, NVIDIA is doing a lot of work with their supply chain partners. They've qualified additional supply chain partners, and they've got supply set to increase every quarter through the entirety of next year. China, NVIDIA clearly stated that expanded restrictions and regulations will not have any impact on near-term financial results. And then the third, which is really important, the digestion period potential. NVIDIA very clearly there too said that they have visibility at least into 2024, and it sounds like 9 months of visibility into demand for these chips and systems. So really nothing to pick at on the call last night.
Okay, so with all of that considered, I mean, so much focus on the data center side and what artificial intelligence can do for that business, but also what about what we all said was the core business for this company prior to the AI hype phase in the GPUs, in the graphics processing units?
Right. So gaming, Brad, used to be 65% of this company's revenue. Guess what? Data center segment was 76% in the quarter reported last night. So clearly a shift into where the investment dollars are going for NVIDIA. And I'd say one of the things that we underestimated was the fact that it's really a generational compute shift. It's not just generative AI that's driving the demand for NVIDIA chips. It's this concept of moving away from x86 general purpose processing servers to servers that are based more on NVIDIA GPUs and less on x86 chips. The reason for that is that it's a more efficient way of processing the workloads that today's data centers need to process, and generative AI is actually accelerating that move. So you've got $1 trillion, Jensen Huang, the CEO of NVIDIA, talked about in installed data center infrastructure globally. And gradually, that infrastructure is going to transition to the type of compute that NVIDIA is doing. So gaming is still important, $2.5 billion or so quarterly revenue I just reported, and it's still a growth area for the company. But certainly when we look at these data center numbers, that's where the action is. We're actually forecasting now data center revenues to increase to $60 billion next year.
Wow. Ruben, one of the other risks that you did mention briefly, China. I wanted to dig into that a little bit. Now, NVIDIA for now seems to have loopholed it, right, and to have developed chips that are still passing muster from the Biden administration to be sold into China. That could, of course, in theory, change, and CFO Colette Kress warned about the ramifications of that on the call last night. How are you sort of gaming out that likelihood of whether indeed we could see more stringent regulations?
We could. It's a little bit of a tough one to call right now because we really don't know how far the U.S. government is going to go on restrictions. I would say that thinking about China as a percentage of overall revenue for NVIDIA, Colette also talked about China being 20 to 25% of the data center segment. So kind of on trend historically. There were some concerns that, hey, are we getting some pull-ins on orders in China because of fears of additional export restrictions? Doesn't seem like that's going on right now. I'd say bigger picture, and this is not really long term, but certainly, what I talked about with visibility into 2024, the way I'm thinking about it is 12 to 24 months worth of demand is out there. NVIDIA's been allocating GPUs and it's global. It's the UK government, like we heard recently in some news, the Saudi Arabian government, it's cloud service providers globally, ex-China and in China. So there's a lot of demand out there and somewhat limited supply still. So we'll see what happens, but for right now, it doesn't seem like it's going to be a big issue for the company.
Just lastly, while we have you here, Ruben, as well, when we think about the price point and that strategy moving forward from here, is there going to be any kind of tail effect to that pricing where you've got some of those early purchasers, early orders that have come in for NVIDIA, and especially within that DGX cloud? But then additionally, how does that need to kind of change over time in order to kind of trickle down to other parts of the potential portfolio client base that they either already do have and they're trying to upsell, or net new clients that they're trying to bring on?
Sure. Right now, NVIDIA is enjoying a dominant position and enjoying pricing as such, right? So there are competitors coming in. AMD's got a competitive platform that's going to start shipping in volume later this year. And it's certainly a lot of companies are trying to figure out alternatives to NVIDIA, given what you just talked about. I mean, these are expensive platforms and chips. The good news for NVIDIA, and there were too many questions on this on the call last night, but gross margins are increasing quite materially. The guidance for October quarter calls for 72.5% gross margin. And that's a combination of data center mix moving up, as well as software becoming a more important part of the sale. This is an ecosystem that NVIDIA is selling: hardware, software, networking. And we think, yes, ASPs certainly over time are going to come down, but as that software component of the cell increases, and it's really early days for that, that's going to drive overall profitability up for the company. And we think that's going to be a very interesting driver in terms of multiple expansion from a longer term perspective.
Ruben Roy, Stifel Applied Technology Analyst. Thanks so much for taking the time here this morning to kick off our NVIDIA discussion. Ruben, appreciate it.
Hewlett-Packard Enterprise out with better than expected results, in large part because of demand for all things AI. Let's get right to the man of the hour here, HPE CEO Antonio Neri. Antonio, always great to get some time with you here. So let's start on the macro economy and the impact to your business. Is the economy in the U.S. and around the world starting to cooperate with a company like yours?
Well, I think we continue to navigate some uncertainty in the microeconomic environment, but I will say IT continue to be a top priority for customers because they need IT to operate in this digital world. And what we saw in the Q3 earnings is that we saw sequential order improvements. The demand improved across all our key business segments, but obviously the star of the demand, I will say, the leader was AI, where we saw a wave of acceleration, also coupled with our HP GreenLake cloud platform. So we have a unique portfolio, and we're taking advantage of the diversified portfolio we have.
Lots to unpack in that AI part of your business. I will touch on that, I promise. But on the enterprise spending, when you talk to large customers, are they still making tough choices? Are they loosening up their budgets? Has that changed at all compared to 3 months ago?
No, I think it continues to be the same, right? So we see areas of the portfolio where the sales cycles continue to be elongated. So they're taking the time, perhaps more approvals in the process. And we see areas where are really becoming stronger. So, for example, everything related to connectivity, connected people, devices, and things to accelerate that data-first modernization, digital transformation is core. because they need to be more effective and efficient in how they conduct the business. And obviously, we saw a significant uptake in AI because everybody wants to adopt AI into the business model. So depending on the area of the portfolio, in some areas, elongated cycles, some other areas, a little bit of more frothy, if you will, but ultimately, all in the right direction because IT will continue to grow on a long period of time.
For the investors on our platform, Antonio, that may not be totally familiar with your business. You saw a large uptick in sales in the Intelligent Edge business, up 50%. Does that reflect demand for AI-related services and products?
Well, remember our portfolio. So we have a cloud platform, which call it HP GreenLake, is a true hybrid cloud platform where we give customers the ability to deploy hybrid IT across the entire estate, whether it's to put workloads and data in the public cloud or on the premises in a co-location or at the edge, even more now. And so that's our HP GreenLake platform. That platform now has under the umbrella $12 billion in cumulative total contract value, and 5 years ago was zero. And then ultimately, we continue to drive that business through the software and services mix, which improves sequentially, again, 2 percentage points, which drive obviously higher margins. But that business grew 122% year over year. And underneath that, Brian, we have 3 core businesses. One is the edge, which is obviously the connectivity business, the networking business. That performed exceptionally well. It's the 5th consecutive quarter of record-breaking revenue and profit. Now that Intelligent Edge business represents 20% of the total company revenue and almost half of the company profit. 2 years ago, it was less than 10% and less than 15%. So massive improvement there is the new core, I would call it, of the company. Hybrid cloud obviously includes compute and storage, which tends to be more cyclical. But at the same time, we have a lot of infrastructure as a service and SaaS, and then obviously AI. And so when I think about our results, clearly we have transformed the portfolio. We continue to make shift to higher growth, higher gross margin areas. And now we see AI as a turbocharge in the future. And we embed AI in everything we do. But as I think about AI, think about how people train data, tune models to their data in a private, secure, responsible way. And then obviously how we use that in our production models, what we refer as AI inference models.
Within your backlog figure, is there a number to parse out in terms of total AI demand? Do you have an idea on how much demand you are building in your book of business because of the AI solutions that you have?
Well, it has grown triple digits, no question. And we exit Q3 with the largest ever order book in our HPC and AI segment. And that was symbiotic with the HP GreenLake because HP GreenLake offer all of that as a service. So it's an accelerator of HP GreenLake, but also AI needs HP GreenLake to offer in a pay-as-you-go model. And then in the rest of the business, we embed AI in our SaaS offerings. Everything related to networking, compute, and storage has now more and more SaaS attached because that software delivers the experience that the customers need through the infrastructure. And that has a component of AI now embedded and will continue to grow as we go forward.
You mentioned on the earnings call, Antonio, NVIDIA. Do you work with them? Do you get chips from them?
Absolutely.
Can you get the chips you need from a company like that? Because all we hear from the outside looking in is that prices for these H100 chips have gone through the moon, and there are essentially only a couple companies getting the chips they need.
Not really. I mean, we work extremely well with Jensen and his team. It's a fabulous team. We have an amazing relationship. In fact, I just spent more than a half a day with him and the team just 10 days ago in his headquarters in the Silicon Valley. We talk about how we grow together, how we bring both sets of assets in a way that democratizes AI for everyone. So I'm very bullish about that. And we have unique value that we bring to the table. Because let's be clear, HPE has been in the AI space for a decade. We have done AI for unique customers in academia, government, and very, very large enterprises that built specific, built-for-purpose systems like supercomputers. Remember, we have deployed the largest supercomputers on the planet, and we have more to come as we look into 2024. And so it's a very symbiotic relationship. Now, our demand had outpaced any supply availability, including for NVIDIA. But what we booked in Q3, only a very small fraction actually shipped. And remember, the revenue recognition that business has additional conditions, which is not the type of shipment, but also the time of receiving and acceptance of these massive systems we deploy.
As someone that has been involved in tech for some time, Antonio, does this feel like a special time in the industry to you? And
Yeah.
what do you think's on tap? What's the biggest thing next year you think we'll all be talking about?
Well, I think about the AI as one of the most important, if not the most important inflection point, at least in my lifetime. I compare this to what I call the Web 1.0 or the mobile shift that we saw. And obviously, it has the potential to disrupt every industry, but also address some of the biggest societal challenges we all live. So it's not just for the context of business, but also in the context of the challenges we live. Think about it, how we accelerate, the reduction of their carbon footprint. When you think about using AI and supercomputer technologies to innovate new technologies to reduce the carbon footprint, we see that every day in climate research and also in things like modeling simulation. When I think about finding cures for diseases like dementia, Alzheimer, and think about COVID, the reason why we got to a vaccine in 9 months is because we had accelerated computing that allowed us to accelerate the research for these compounds that ultimately address these viruses. But there's so many use cases out there. The key here is to do it in a sustainable, responsible way. And sustainability is going to be essential because this type of accelerated compute consume a lot of power. And Hewlett-Packard Enterprise is uniquely positioned to deploy the most sustainable supercomputers on the planet because we have that expertise. So we believe we're on the cusp of some revolution. What comes next, I don't know exactly, but I will say, obviously, we see quantum computing emerging along the way, neural computing as well. So it's just a remarkable time to be in this industry. And I have a lot of fun with my team tackling the challenges and the opportunities.
And we've had a lot of fun following all these things that you guys continue to work on over there at HP. Antonio Neri, always great to get some time with you. We'll talk to you soon. We appreciate it.
Thank you, Brian.
Salesforce earnings were released last night, and the company not only beat expectations for revenue and adjusted earnings per share, but boosted its current quarter and full year forecasts for revenue, earnings, and margins as well. Like every other tech company right now, Salesforce mentioned artificial intelligence a lot on its earnings call. Co-CEO Mark Benioff explaining his aspirations for the company in the AI space. And to talk more about Salesforce as an AI play, we have one of the best guessers in the business, Brent Thill, a senior analyst over at Jefferies. Brent, make some sense of this quarter for us and your outlook as you continue to kind of parse through the numbers here and even the tenor of the call last night.
Yeah, good morning. The stock is going higher on margin, not really revenue. So Salesforce.com, came into the year massively overweight. They need to hit the Peloton and hit the air brakes on carbs. And they have done that. And that has seen a material outperformance in margin. The margins are continuing to improve. Revenue growth is still stuck in the low teens. And as Mark Benioff, the CEO, said, I'm a growth CEO. They want that number higher. And we think ultimately, if you listen to all the AI hype, today it's not revenue. So the AI revenue wave is going to hit them. So effectively, the first wave of the stock outperformance has been on margin. The second wave should come with revenue outperformance. And again, it's early in AI. I think they're a little behind. You're going to see the revenue from that have a bigger impact in 2024. And then I think, they've gone on a diet on M&A. They haven't done really any M&A. So the other thing that could help reaccelerate revenue growth is, do they lean back in and do some tactical acquisitions that help fill out the portfolio? So remember, the activists said, no more M&A. You got to cut your weight, get your margin higher. I don't care about revenue growth. And they set a goal of double-digit top line with high 20% operating margins. They're now there. And then the next leg of this is that margins are going to go, in our opinion, to 35 to 40%. And hopefully they can, reaccelerate revenue growth from low teens to mid teens. So story still got a lot of legs. We think stock's going higher.
So Brent,
a lot to break down in what you just said, but sticking with your last point there on M&A, because like you said, activist investors obviously were pressuring Benioff, wanted him to cut back on some of his spending. So here we are with Salesforce almost a year later, and like you're saying, in a much better position than it was 9 months ago. So what do you think, I guess, how do you think Benioff is thinking about potential M&A strategy, and what could be attractive to him?
Well, remember, I mean, they've been addicted to M&A. They've done so much M&A. They've done more M&A than most of the companies we cover. So they were hooked on a drug called M&A, and they had to go to rehab. So I think there's a lot that they could do. I think right now the number one area obviously is AI. Is there a tactical tuck-in or startup that has great technology, doesn't have distribution, that they could infuse inside their platform? That would be number one. Obviously, number two, they've been very open about acquiring inside their own portfolios. So marketing, sales, service, you go through all these applications. There's a lot of point solutions in the front office that they could tuck in on that side. But if you the number one thing for me would be a tactical AI tuck-in. Is there some enabling front office technology AI story that is out there? It could be 3 girls and 5 guys and a dog, right? That as a startup that they could do as a tactical. But I don't think they can go out and do a Slack-like deal. Remember, that deal went completely sideways, and they overpaid. So I don't think you're going to see anything like that. More on the smaller to mid-size than large.
As long as that small startup got that dog in them, it should be okay, and an acquisition target as well. When we think about AI, though, is the analyst community comfortable, or how do you even evaluate making sure that for the AI solutions that get introduced, that it's not cannibalizing other parts of the business?
Well, ultimately, it will over time. So if you think about what Salesforce.com does, is they sell service seats into a call center that you call. So a major airline, if you call your insurance company, they're most likely going to use Salesforce.com. And so AI at some point, like, we don't want to talk to these reps, nothing against talking to humans, but like we can get this answered by the computer. And so ultimately over time, what happens is if AI really works, it does reduce the number of seats available to them over time. Now that's a long ways out, but the flip side of this, they will charge more per seat. So if they charge $10 a seat, they can charge 20 because they're physically removing a human who's a lot more expensive than that piece of software. So I think for them, over time we'll see, and this is a long-term concern, not a short-term concern. The long-term concern is, is this going to reduce the number of seats available? Do you need as many sales reps or service reps? And again, I don't think that's a 2024 event. I think it's a 25 and beyond. But they will charge more per user, so their monetization will be at or greater than that before this. And then remember, a lot of people will add on. AI isn't going to fly the plane. It's basically it's going to be a co-pilot. It's not going to be the full pilot, as they call it. And so it's going to be augmenting rather than replacement. I was up at Microsoft this week looking at their AI technology. And again, it's not going to replace a human. It's going to effectively augment and make you more productive in what you do every day, get you through your emails, help you make presentations, help you prepare for that sales call. Even if you're a service agent, they may keep these bodies in place. But if you're working for a major airline, I know you're a VIP, and I know that you're vegetarian, and I know you like a certain drink. I'm going to do it right away based on the AI technology, and that makes you happier as a customer. You're going to come back and rebook. So again, it doesn't really mean right away we're going to have humans out of the picture. It just means it's hopefully going to be a better experience for everyone.
All right, Brent, we could talk about this all day, but we also got to get to another topic that I know you've been following here over the last several months. Elon Musk, he's adding another new feature to his soon-to-be everything app, X, formerly known as Twitter. Now he's planning to launch video and audio calls to the platform. Musk, he's desperate, right, to fend off competition from Meta Platforms' owned Thread. So how worried should Zuckerberg and Meta be just about these moves, or do you think Elon Musk is just grasping at straws at this point?
I think if you're Zuck, you're really not concerned at all about what is happening here. Again, I think the market's big enough. I think users go to the platforms for different reasons. I think for Meta, they've demonstrated through their expansion of their portfolio that they have a very sticky platform, that they can create all these features. I think, again, many use Meta and the portal with our hardware launch, many years ago to do video calls. I have a portal on my parents' house, so my kids can interact with them. So, that like video's been there forever. I mean, they have actually a device that people actually really like in living rooms that they're already using. So again, I think, the thing with Twitter and X is they've tried many times, and every time they kind of come back to users and they come back to advertisers, it's kind of like a broken record, right? They want a cleaner approach. They want something that works, and it's been a series of roundabouts. They just get stuck in this roundabout and keep going around. They need to figure out how do they break out of the pattern, if you will, and go somewhere new and do something exciting. So we'll see. We're not ruling them out. They have a lot of work to do, but I'm not worried if I'm Zuck.
Is Meta a net beneficiary then of some of the strategic question marks that still circle around X?
100%. 100%. I mean, advertisers right now are like, I'm not giving them as many dollars. I'm giving them back to Meta. In all of our checks, Google and Meta are taking market share away from them. They're taking share from others. So if you look at the outperformance of Meta stock up 145% plus year to date and Google up 54%, that's because the users are staying there and they're getting advertiser market share. I mean, I just dropped, I don't know how much more money on the NFL ticket for YouTube TV, right? Just gave Google more money. Advertisers are excited about that. They keep innovating, and I think this is the thing. Being big isn't bad, and they're just doing the right things for the users. And I just see, again, even in the AI race, Google's doing more AI things behind the scenes than anyone can see. They're way ahead of anyone else, and so the industry's saying that. Wall Street's not saying that, but that's why stock keeps going higher, because now they're winning. Companies like Workday, Amazon's AI wasn't working; they had to go to Google. So Google and Meta are in really phenomenal positions. They're continuing to get stronger. They're doing the right thing for the consumers. And if they do the right thing for the consumer, guess who comes? The guys that pay the bills. Those are the advertisers. They're not going to the other platforms as well. So Snap and Twitter or X have lost share.
Brent Thill, always great to have you. Look forward to having you back soon. Brent Thill of Jefferies, senior analyst.
Lululemon reporting a beat on revenue but missing on earnings. However, the company boosted its net revenue forecast for the year. Shares are trading flat in after-hours trading. Here to dig into the numbers is Brian Nagel, Oppenheimer Managing Director and Senior Analyst. Brian, what do you make of this report, especially in comparison to other retailers like Dick's, for example, which certainly struggled in the quarter?
Well, good afternoon. Look, I think this is a very solid report from Lululemon. We're just digging through these results right now, but if I'm looking at the numbers correctly, I think you actually had a modest beat on the top line and a modest beat on EPS as well. It looks like the EPS came in at $2.68, which is maybe a 10, 15 cents better than the street number. So, look, I think the results here from Lulu are very solid. Okay, now to tie that over with Dick's, look, there was some noise in the Dick's announcement. Particularly around shrink, and that's been an issue. A lot of these retailers now have been focused, but behind that, behind the shrink issue with Dick's, their results were quite solid as well. So what I think we're seeing here is, really overall within this sporting goods and this athletic space, very solid results, continued indications of solid consumer demand.
Yeah, what does that tell you, Brian, about where consumers are prioritizing things? You know, we were talking earlier before the break about how much we've heard from these big name retailers about discretionary spending coming down. You're seeing strength, you're saying with Dick's, with Lululemon. What does that tell you about sort of the mind of the consumer right now?
Sure. Look, I've studied the consumer for a long time, a couple decades at least now. And I would say this is one of the most fluid, frankly, one of the most confusing consumer environments I've ever seen. And there's a lot of trade-offs, you know, and it's definitely not one size fits all, okay? So to answer your question, look, I think what we're seeing here is a discerning consumer. You know, post-pandemic, there's clearly this shift back in spending to services, you know, that's travel, you know, eating out, sporting events, whatever, you know, and so to a certain extent now that shift is impacting sales in categories that performed very well during the pandemic. But if you look at Lululemon, you know, I think one of the big trends here is, you know, so Lulu performed well through the pandemic, right? But I think what's happening here post-pandemic is, as a society, we are still dressing a lot more casually. You know, so this ongoing strength in Lululemon, the double-digit sales growth, to a certain extent, is coming at the expense of more traditional clothing companies. You know, just because now we're dressing athleisure-wise, you know, in more aspects of our lives, including work.
And you mentioned shrink and how that was a big problem for Dick's. There was no mention of shrink or retail theft in this press release. We'll see if it comes up on the call. But if shrink isn't a big problem for Lulu, why is that the case? Is it because it's in a higher end category?
It's possible. You know, I mean, look, it's an interesting question. Well, again, like you said, we're going to have to see what they say on their call, because I'm sure it's going to come up. But I mean, one piece, you know, one factor is, you know, a large portion of Lululemon sales are online. Okay, so that, you know, that just by its nature protects from in-store shrink. You know, but you also have a number of their stores are mall-based. Okay, so maybe, you know, there's better protections for these stores there. They're generally smaller stores. They've got a lot of service personnel in these stores. You know, so all those factors can help protect the kind of shrink that we're seeing elsewhere, particularly more the big box stores.
I want to pick up on that point. You said a lot of their stores are mall-based. And when I think of Lululemon, I think of the mall. I think of these shopping centers. They are making advancements on the digital side, but we have seen a slowdown in foot traffic when it comes to brick and mortar. What's the outlook there? Do you think they're going to have to close more stores, or is that something they should be leaning in on?
Well, look, one of the big advantages of the Lulu model is, you know, I've made this point for a long time now, is that they're really starting from scratch, right? I mean, this is truly a direct-to-consumer brand that uses the company's stores as a means to drive direct-to-consumer sales, okay? And that's very different than a lot of other brands and a lot of other retailers. You know, you take Nike, for example. We're big fans of Nike too, but, you know, one of the challenges for Nike over the last, you know, few or several years now has been that they've had to sort of say dismantle or at least reconfigure their wholesale distribution network, you know, as they had to think about their partnerships in wholesale. Lululemon has not had to deal with that. You know, their wholesale business is very small. It's direct to consumer. A lot of it's online, and a lot of it's in their own store. So when they open a store, you know, and they talk about this a lot. I mean, that store, you know, acts as a place to sell product, but also very much complements the online offering, right? And that's how they continue to open stores in the United States as well as in markets across the world. So I don't see them closing stores. You know, I think they're very much in an optimal position here as far as store openings, because they're picking off the best locations and doing it smartly.
I can tell you're very bullish on Lulu. You have an outperform rating on the stock. What are your biggest concerns, though, as we think about the future, the uncertainties with the macro environment, potentially more interest rates? We are seeing a more pressured consumer. Is there an area of the business that you are a little bit concerned about?
Well, we can't ignore the macro environment, right? We can't. I mean, look, I'm of the view, you know, and given my, you know, kind of my perspective on the consumer, I think the consumer is holding in very well, you know, despite, you know, rather significant interest rate hikes and other, you know, pressures out there. But I think the consumer is holding in very well. Now, but one risk is, and we cannot ignore this. I mean, if the U.S. economy, I don't think it's going to happen, but if the U.S. economy were to shift into some type of more significant recession, you know, here's Lululemon, and yeah, this is a high quality product. There's a lot of demand. There's a lot of passion around this brand, but it's high priced. And you got to think that if we went into a really, you know, significant consumer pullback, sales of Lululemon would get hurt. Okay, so that's one risk. The other fact, you got to keep, you know, competition. I mean, I think Lululemon's doing a great job within the athleisure space. I mentioned a moment ago they're taking market share from other kind of clothing brands. But look, it's a very competitive space, and the consumer has been historically fickle when it comes to this type of product. So we've got to see continued innovation from Lululemon. They've got to stay true to their brand to fend off this competition, either in terms of the major players like a Nike or a lot of the smaller players that keep on popping up.
Well, you're right about the higher prices. Those Lululemon yoga pants, they're not cheap, and I know that from experience. But Brian Nagel from Oppenheimer, thank you so much. Talk soon.
Thanks for having me. I appreciate it.